Hello everyone and welcome back to the channel. Today, we're diving deep into a stock that's been generating a lot of buzz in the streaming world, Fubo TV, ticker symbol FUBO. Fubo TV is a sports-first streaming platform that has recently been making major headlines. While it currently trades near $3.54, residing far from its 52-week high of $6.45, it stands significantly above its 52-week low of $1.21. The stock has shown noticeable volatility, sometimes going 2 to 3 times its value in a single day based on news. Initially seen by some as a niche player struggling against tech giants, Fubo is undergoing a transformative shift. The company is actively reinventing its strategy, moving from a reckless pursuit of growth at all costs to a disciplined focus on profitability and an optimized business model. In this video, we'll break down Fubo's unique value proposition, the game-changing Disney acquisition deal, their innovative new, skinny bundles, and what all this means for its future potential and stock price. Stick around, because this could be one of the most interesting media plays in the coming years. Let's start with the basics. Fubo was launched in 2015 as a sports-only streaming service, and over the years, it has evolved into a full live TV platform, offering not only sports but also news and entertainment. It primarily operates in North America but has been expanding into markets like Canada, Spain, and France. What makes Fubo unique is its laser focus on sports. Sports is considered one of the stickiest and most valuable types of content in streaming, and frankly, in the entire entertainment world. This focus gives Fubo a significant competitive advantage in media. In the broader streaming landscape, sports entertainment rights are incredibly spread out. If you're a fan of multiple sports, you often have to pay for numerous separate subscriptions. Fubo's original aim was to bundle these subscriptions into convenient packages, making it easier for the consumer. However, initially, some found that unless you were a fan of every sport, the bundles came with too much content, leading to higher costs and Fubo bleeding money. Despite past challenges, the platform itself has built a strong reputation. In fact, Fubo has been ranked number 1 in customer satisfaction among live TV streaming services. While its stock chart has been a roller coaster, the product continues to prove itself with users. Fubo's strength isn't just in its content but in its ability to understand what its core sports audience values most. This insight is driving its strategy to offer a more compelling, lean, and ultimately more profitable service. Now, let's talk about where things get really exciting. Fubo's major merger with Disney's Hulu Plus live TV business, announced in early 2025. This deal gave the stock a significant upside in 2025, with the stock jumping to around $5 after the announcement. This merger is a massive development. Disney plans on combining Fubo with Hulu Live, which is also theirs, and they are going to own a 70% stake in the new combined company, with Fubo holding 30%. Importantly, the combined company will still operate under the same name and ticker symbol of Fubo TV, and it will continue to be led by its current CEO, David Gandler, and the existing management team. However, Disney will appoint members to its own board of directors. This deal instantly made Fubo the second largest online pay TV provider in North America, boasting over 6 million combined subscribers and roughly $6 billion in annual revenue. The financial backing from Disney is substantial. Disney is providing $220 million in cash and a $145 million loan to support Fubo's balance sheet. This infusion of cash brings huge financial backing and credibility to a company that, until recently, was considered a smaller player. Beyond the financial aspects, this deal has several other critical benefits. It grants Fubo access to all the ESPN networks, ABC, and various other sports networks owned by Disney. It settles all ongoing litigation between Fubo and Disney, bringing an end to Fubo's legal battles with Disney, Fox, and Warner Bros. Discovery. This means less uncertainty and better cooperation with content providers. The deal enhances Fubo's negotiation power, provides more pricing flexibility, and significantly broadens its content library. If, for some reason, the deal doesn't go through, Fubo still gets a termination fee of $130 million, which is a considerable sum. With this merger, Fubo can essentially double its cash pile and significantly lower its cost of goods sold, COGS, and other expenses, especially with the legal disputes out of the way. This will enable them to provide a better service at a cheaper price point, positioning them as a truly competitive player in the market. This merger is not just about Fubo's survival, it's about Disney recognizing Fubo's unique value proposition. Fubo is the only live TV streaming platform with every English-language Nielsen-rated sports channel. Disney is acquiring Fubo's expertise in live sports, interactive features like multi-view, and its lean and mean profitability model, which could be the secret sauce for the combined entity in the streaming world. In a significant move, Fubo has recently released its skinny bundle offering, called Fubo Sports, which launched on August 28. This offering comes just as the NFL season gets underway. Fubo Sports is a standalone plan featuring over 20 sports and broadcasting networks, providing national and local professional and college team coverage. It launched with a promotional offer of $45.99 for the first month, then $55.99 per month going forward. The networks included at launch are robust, featuring local broadcast stations owned by ABC, CBS, and Fox, plus additional affiliates in select markets. It also includes essential sports channels like ACC Network, Big Ten Network, CBS Sports Network, ESPN, ESPN2, ESPN News, ESPNU, Fox News, FS1, FS2, Fubo Sports Network, ION, NFL Network, SEC Network, and Tennis Channel, with some Network 4K content also available. Furthermore, access to ESPN's new direct-to-consumer unlimited plan, which includes ESPN Plus, is bundled with a Fubo Sports subscription. While Fubo Sports covers most football offerings, the only notable absence for American football fans is NBC, meaning Sunday Night Football might be missed with this specific skinny bundle. However, even if you add Peacock Premium for NBC, which costs about $11, the total monthly cost of $67 is still $3 cheaper than DirecTV's $70 a month offering. Since Sunday Night Football is a standalone game, multi-view isn't essential for that specific broadcast. If you like this content, please subscribe to see more videos like this. Fubo Sports offers clear value when compared to subscribing to individual services or even upcoming bundles. For example, if you were to subscribe to ESPN Standalone Unlimited and Fox One Standalone, it would cost around $50 total. For just $5 more, $55.99, Fubo Sports not only gives you Fox and ESPN but also plenty more content. Key differentiators that Fubo Sports provides over just the ESPN Unlimited and Fox One bundle include CBS Sports Network, NFL Network, Tennis Channel, and ION, which features WNBA and NHL content. Perhaps one of the most compelling advantages of Fubo Sports is the unified app experience and the multi-view feature. Instead of juggling between multiple apps like ESPN and Fox to watch different games, Fubo allows you to combine all content into one app and utilize its multi-view feature. This means you can watch up to 4 games playing at once on your TV through the Fubo app. This unified, multi-screen viewing capability is a true competitive advantage, providing a seamless and enhanced viewing experience that other standalone services don't offer. The CEO, David Gandler, emphasizes Fubo's belief that a streaming service must provide consumers with multiple, flexible, and affordable content options, allowing them to subscribe to the content they choose. The launch of Fubo Sports adds another content tier to their broad portfolio, specifically super serving passionate sports fans. This skinny bundle is expected to be a significant growth driver for the company, catering to price-sensitive, sports-obsessed cord cutters. A crucial insight that challenges the prevailing narrative about Fubo is its recent and deliberate shift away from a subscriber at all costs model. For years, the market viewed streaming companies primarily through the lens of subscriber growth, often ignoring staggering losses incurred to acquire each user. Fubo initially played this game, resulting in ballooning net losses. However, Fubo delivered a stunning plot twist in its most recent quarter. The company not only exceeded its revenue guidance but also achieved something far more significant: its first quarter of positive adjusted EBITDA, reaching over $20 million. This milestone represents a staggering $31.7 million improvement year-over-year. This achievement came despite a decline in its North American subscriber base, which was a conscious strategic decision. Fubo pruned its less profitable, high-churn subscribers and focused on optimizing its customer base for higher average revenue per user, ARPU. This data-driven approach shows its North American ARPU continues to climb, driven by a higher value, more engaged user base willing to pay for premium sports content. This strategic discipline signals a maturation of the company's leadership and a fundamental re-evaluation of its long-term viability, moving from a speculation play to a genuine business with a path to free cash flow. On a micro level, Fubo is actively renegotiating content deals and shedding networks that do not meet its profitability metrics. This means walking away from deals where licensing costs are disproportionately high relative to the value they add to the subscriber base. This difficult but necessary move, which few competitors are willing to make, shifts the focus from top-line revenue to bottom-line efficiency. Beyond North America, Fubo is also pursuing an intelligent international and multi-platform strategy. Its acquisition of Molotov in France is a potentially transformative move. Molotov is not just another streaming service, it's a technology platform with a significant user base and deep understanding of the European market. By integrating its technology with Molotov's platform, Fubo gains a foothold in a new geographic region and diversifies its revenue streams, exploring new exclusive content offerings not beholden to bloated US licensing costs. The company's recent partnership with DAZN in Canada further illustrates this international ambition, expanding content without massive upfront capital expenditures. Fubo is also strategically reviewing its sports betting unit, exploring partnerships with established operators rather than building a costly in-house sportsbook. This de-risks a major initiative while still capitalizing on a multi-billion-dollar market. What does this all mean for Fubo stock? While it's currently a volatile penny stock, anything could happen with the merger. The Disney deal is the main true driver of the stock price in the short, medium, and long term. Voting on the merger is scheduled for September 30th, with hopes for movement in early to mid-October. If the Disney deal goes through, some predict the stock could reach $10 plus and hold. One optimistic view suggests the stock could hit $50 in a few years if Fubo executes well. Wall Street's average 12-month target is above $5.50, which would represent a 50% upside from current prices. Looking further ahead, considering the Hulu deal, subscriber growth, and a stronger balance sheet, a realistic target for June 2026 is around $6 per share. This is considered very possible if the company maintains its current trajectory. In essence, Fubo has divested from a niche underdog into a serious player. Disney's backing provides financial strength and credibility, and the stock has a realistic path to $6 by mid-2026. To wrap it up, Fubo's story is a compelling one of expectations versus reality. What was once seen as a cash-burning niche player is now a company that has undergone a fundamental transformation, pivoting to a disciplined and profitable business model. The strategic alliance with Disney's Hulu Live TV massively expands Fubo's scale and reinforces its unique value as a sports-first platform. Coupled with its innovative skinny bundles, focus on higher ARPU, and smart international expansion, Fubo is rewriting the rules of the streaming wars. While others chase subscriber numbers at unsustainable costs, Fubo is proving that a targeted, profitable business can be far more compelling in the long run. For investors looking at the future of streaming and sports, Fubo TV is definitely worth watching. Thank you for watching, and we'll see you in the next video. Remember to like and subscribe to stay updated.